Welcome back to the Deep Dive. Today we are breaking down the Q3 2025 earnings call for SI-BONE Inc.
And look, every quarter is important. We say that all the time.
But this one felt different. This wasn't just, a solid beat.
No, all the data here, it really points to the company finally hitting that inflection point, that crucial, sustainable turn that investors have been waiting for.
That's exactly the mission for this deep dive. We need to unpack that.
Right. The whole financial story really shifted this quarter. We're moving past the simple narrative of a high-growth company just burning cash.
And into the new chapter.
Exactly. A chapter where they're showing profitable scalability. So we're going to focus on three things. First, validating that move to positive cash flow.
Okay.
Second, really understanding this new, broader Sacropelvic platform strategy.
And third,
we have to detail the specific reimbursement wins, especially that NTP, because that's what really drove the stock's big double-digit jump.
all right, let's start with the hard numbers then, because they're the foundation for this whole shift.
Let's do it.
Worldwide revenue for Q3, $48.7 million.
Which blew right past the consensus estimate. I think analysts were around 46.7 million.
So a solid beat. And that translates to year-over-year growth of 20.6%.
I mean, you just don't see that very often. A medtech company holding on to that 20% plus growth rate while also getting their costs under control.
And that discipline is why this quarter really hit different. The top line strength flowed straight to the bottom line.
It really did. So GAAP earnings per share, it came in at negative 11 cents.
Which, yes, is still a loss. But context is everything here.
Everything. The consensus was expecting a loss of 16 cents, so they beat that by a full 5 cents. They're closing that gap much, much faster than anyone thought.
And that's the leverage kicking in.
It is. And here's where that inflection point becomes, undeniable. The main profitability metric, adjusted EBITDA.
It flipped.
Emphatically, positive $2.3 million. That's a 5% margin. And it confirms the trend we started to see last quarter.
So this is now the second quarter in a row of positive adjusted EBITDA. A huge improvement from the loss of $200,000 they posted a year ago.
Right. It basically confirms that management's internal goal now is to run this business profitably.
And for anyone listening who thinks this might be, some kind of accounting trick, you just look at the cash flow.
That's the real proof. For the first time, they delivered meaningfully positive cash flow from operations, generated $2.3 million.
Brandis was very quick to point that out on the call.
And they should be. It means they are effectively shifting from being cash dependent to becoming a self-funding compounder. They can now fund their own R&D.
And their own commercial expansion.
Exactly. All from the cash the business itself is generating.
So let's drill down on how they did that. Because it wasn't just about high sales, it was about efficiency.
The leverage story. They hit 1.7 times operating leverage in the quarter.
Which for you listening is a simple but really powerful concept.
It just means their revenue, which grew about 21%.
Grew almost twice as fast as their operating expenses, which only grew about 12%.
That's it. It proves the model is scalable. It means more of every new dollar of revenue drops to the bottom line.
That discipline is fantastic, but the engine is the surgeon base.
Yeah.
And this is where the numbers get, frankly, a little wild.
The momentum in physician adoption it's just fascinating. They reported 1,530 active U.S. physicians.
That's a 27% jump year over year. Massive.
But the real kicker was the quarterly number. A record 330 new surgeons in Q3 alone.
330 new surgeons in just 3 months.
Yeah. That kind of acceleration gives you enormous visibility into where revenue is going next.
But it does raise a question, right? Are they risking dilution? I mean, are these new surgeons coming online fast enough to justify the cost, or are they just chasing volume?
That's a super critical question, and the data they provided gives a pretty strong rebuttal. It all comes down to territory productivity. This was the 12th consecutive quarter of double-digit territory productivity growth.
The 12th.
So the trailing 12-month revenue per territory is now $2.1 million, up 16% year over year.
So that shows the existing sales force is getting more efficient, and the new folks are ramping up quickly.
Perfectly. It suggests their training and their targeting models are working exactly as they should be.
Okay, that puts the numbers in perspective. High growth and improving efficiency. Now we have to touch on margins. Another pleasant surprise.
Huge surprise. Gross margin came in at 79.8%. world-class for a med tech company.
It is, but management was also pretty upfront about the future there.
Yeah, they were very candid. They basically said 79.8 might be the peak for now. They expect it to normalize a little lower.
Somewhere around 78 to 78.5%.
Nice. As they mix in some of these newer, more innovative products that have, different cost structures at the start.
But they were clear that the overall durability of these high margins is not in question.
And that's the critical part, because that's the fuel for all their R&D.
Speaking of fuel, the balance sheet gives them total flexibility. They ended the quarter with, what, $145 million in cash?
$145.7 million in cash and marketable securities. And when you subtract their tiny bit of debt, you're looking at a net cash position of about $110 million.
So they are fully funded. They don't have to go back to the markets to fund this next stage of growth.
Which brings us perfectly to the big strategic transition they're making.
Right. If you connect all these dots, you can see management is executing a very deliberate pivot.
They want the market to stop thinking of them as just the iFuse SI joint fusion company.
They're becoming something broader. A Sacropelvic platform company.
That's the term.
So what does that actually mean? Because Sacropelvic platform sounds a little bit like industry jargon.
It is jargon, but it's meaningful jargon. It's how they unlock new markets. So the platform now includes products like Granite for lumbopelvic fixation in spine fusions, and iFuse-TORQ TNT, which is for trauma, for complex pelvic fracture.
So they're leveraging their existing surgeon relationships in the pelvic area to cross-sell into related procedures.
It's a classic playbook. If you already have the relationship with the doctor, sell them more stuff.
Makes sense. Let's talk about a totally new market they're going after now, the interventionalists.
This is a huge, largely untapped opportunity for them. Management said there are something like 4,500 interventional physicians out there who could be using their products.
But very few are right now.
Right. These are the physicians doing more office-based procedures, mainly using the intra-product for SI joint pain.
And the key stat there was that case volume in that segment doubled year over year in Q3.
It doubled. That growth is already great, but the real kicker is the 2026 CMS reimbursement update.
Ah, the tailwind. What's changing?
So CMS finalized a pretty substantial 17% increase in reimbursement for these office-based SI joint procedures.
Which directly benefits that intra-product.
Directly. It's this enormous regulatory tailwind because it just makes the procedure more profitable for the providers. It accelerates that shift out of the expensive hospital and into the clinic or an ASC.
That's a great boost on the interventional side. But the biggest catalyst this quarter, the one that really moved the stock, was tied to the trauma market.
Specifically to that TNT product and the new technology add-on payment, the NTT.
We have to define that.
Right. So an NTT is basically a temporary, a regulatory cheat code for breakthrough medical devices.
And iFuse-TORQ TNT got one.
It did. And the payment became effective October 1st, 2025. And the impact is what's so fascinating. It adds $4,100 per eligible procedure.
Okay, so what does an extra $4,100 actually mean in the real world for a hospital?
It fundamentally changes the economic calculation for them. On a complex pelvic fracture, that $4,100 add-on is up to a 30% increase in the total reimbursement for that case.
Wow.
So before, the hospital might have struggled to cover the cost of the device. Now that economic friction is, well, it's pretty much gone for the people holding the purse strings.
And we already have proof this is changing behavior.
Oh, absolutely. Management said that this reimbursement clarity has already led to a threefold increase in the number of trauma surgeons using their solutions.
A threefold increase.
It's the clearest possible sign that in medtech, reimbursement certainty is the fastest path to adoption.
Which makes the pipeline for 2026 extremely exciting. They confirmed they're leaning hard into the ASC environment.
Right. Ambulatory surgery centers, that's where all the growth is in spine and ortho. So they're launching a new SI joint fusion product in Q1 2026, specifically designed for that setting.
To streamline workflow, maybe reduce procedure time.
Exactly. The two things an ASC cares about most, it's about extending their leadership in that high growth area.
But the other big pipeline item, their third breakthrough device, this sounds like it could be a monster.
It has the potential to be transformative, yeah. They're targeting late 2026 for the 510(k) submission to the FDA.
So the standard pathway for clearance.
Right. And crucially, this device is designed to address a major unmet need in spine surgery, and they're already planning to go after NTA status for it.
So they're building A repeatable playbook.
That's it. Breakthrough innovation, a clear regulatory path, and then a massive reimbursement tailwind to drive adoption.
We should also touch on the international side. Is this just a U.S. story?
Not anymore. International revenue actually saw a nice acceleration. It grew over 10% year over year.
Mostly driven by Europe.
Mostly driven by the recent European launch of iFuse-TORQ, yeah.
Huh.
Management expects that to accelerate even more in 2026 as that platform approach starts to gain traction overseas.
So when you add it all up, the growth, the discipline, the pipeline, what was the bottom line for investors? What did they do with guidance?
Well, given the huge Q3 beat and the visibility from the NTT, they confidently raised their full year 2025 guidance.
They lifted the revenue forecast to a range of 198 to 200 million.
Which implies really strong 18 to 20% year-over-year growth.
And they also raised the gross margin expectation up to that durable high-end level of 79.5%.
It was a classic beat and raise quarter. It just solidifies confidence in their whole trajectory.
And the strategic focus is brilliant. It's not just about adding new surgeons, it's about increasing procedure density.
Exactly. Cross-selling to the 1,500 they already have.
Management pointed out that only about 25% of their core SI joint surgeons are using the other platform products like Granite or TNT.
Which means a full 3/4 of their existing high-value surgeon base is still an untapped well of new volume. It's a built-in growth engine.
Now, we do have to touch on the one point that was a slight, let's say, note of caution for 2026, and that was operating leverage.
Right. Their medium-term target is strong, 1.25 to 1.75x. But for 2026, they signaled it might be at the low end of that range, maybe 1.3x.
So why the slowdown in profit expansion?
This is the strategic trade-off, and you have to analyze it critically. They are telling the market very explicitly that they are prioritizing investment over near-term profit.
They're funding the big product launches for 2026.
Aggressively funding them. The R&D, the commercial build-out, especially for that third breakthrough device.
So it's a conscious choice to sacrifice some profit next year to ensure a massive launch success. Is that a wise gamble?
Look, it's a calculated risk with a huge potential payoff. If you're an investor who just wants near-term profit, this is a headwind. But if you buy into the long-term story,
But these new products are going to be transformative.
then this investment phase is what sets them up for a massive revenue acceleration event in 2027 and beyond. The downside is obvious. If the launches slip, the market will punish them for that lower leverage number.
When you zoom out, though, this growth profile, 21% revenue growth in Q3, the guide at 18 to 20%. It's just staggering compared to the rest of the sector.
It really is. The broader orthopedic device sector is projected to grow at maybe 4% a year. SI-BONE is just in a different league. They're a true share gainer.
And the market recognized that immediately. The stock jumped over 16% after the call.
It did. And street sentiment is highly bullish. This profitable pivot narrative has fundamentally re-rated the stock in the eyes of investors.
Okay, let's turn this analysis into a thesis.
Let's do it. We want to synthesize everything we've talked about. The NTP, the surgeon adoption, that profitable pivot into an actionable idea. And a reminder, this is not financial advice.
We're simply framing a hypothetical strategy based on the analysis.
And the thesis is pretty clear. The company is past its cash-burning phase, and that NTP provides a critical economic floor that should sustain growth well into 2026.
The argument being the stock is currently undervalued relative to its growth.
Right. So if you believe this momentum continues into the 2026 product launches, a leveraged bullish strategy becomes plausible.
How would you express that?
One way would be to establish a long position using a deep-in-the-money call option, say, for example, a 9-month option with an $18 strike.
So you get the upside exposure, but with a lower capital outlay than buying the stock itself.
Exactly. And to make it even more efficient, you could offset the cost of that call premium by simultaneously selling an out-of-the-money put option.
Maybe below the stock's old technical support levels, something like a 1550 strike, same duration.
Right. The bet you're making is that the stock's floor, the price it's unlikely to fall below, has been permanently raised by this news.
You're accepting the risk that if the 2026 pipeline completely collapses, the stock could fall back to that 1550 level.
But you're leveraging your conviction that this new profitable momentum is for real and that it's irreversible.
So what does this all mean for you? The primary takeaway from this Q3 call is that SI-BONE has successfully solidified its transition. They're no longer just a cash-burning growth story.
They've proven they can be a company that shows profitable scalability, real operating leverage, all while still growing the top line at over 20%.
They've shown they can grow fast and manage costs.
But we come back to that critical trade-off for 2026. Management is choosing to spend on R&D and commercial expansion instead of maximizing near-term leverage.
Which leaves you, the investor, with a crucial final question to track.
Is this aggressive investment setting the company up for a massive multi-year revenue acceleration starting in 2027?
Or does this high-stakes investment phase just leave them vulnerable to a sharp disappointment if those new product launches get delayed or underperform?
That gap between investment and payoff is what the market will be watching very, very closely now.
Remember, the information discussed is strictly based on the provided source material and is for informational and educational purposes only. It is not investment advice. Thank you for joining us for the deep dive.
We'll catch you next time.